The Warren Buffett Way, unlocking the secrets of America's greatest investor. When it comes to investing, few names resonate as powerfully as Warren Buffett. Known as the Oracle of Omaha, Buffett has built an extraordinary legacy through his leadership of Berkshire Hathaway, transforming a struggling textile company into a global powerhouse. His investment philosophy, detailed in Robert G. Hagstrom's and Warren Buffett Way, 3rd edition, offers timeless lessons for American investors seeking to grow their wealth. This summary dives deep into Buffett's strategies, exploring his core principles, real-world case studies, and the mindset that sets him apart. Whether you're a beginner or a seasoned investor in the USA, these insights can help you navigate the stock market with confidence and aim for long-term success. Who is Warren Buffett? A snapshot of a legend. Warren Buffett's story begins in Omaha, Nebraska, where he was born in 1930. From delivering newspapers as a kid to making his first stock purchase at age 11, city service preferred, Buffett showed an early knack for business. Today, he's one of the richest people in the world, with Berkshire Hathaway's investments spanning industries like insurance, railroads, and consumer goods. What makes him unique? His ability to consistently outperform the market, a feat so rare it's compared to a Phi Sigma event, a statistical anomaly with odds of 1 in 3.5 million. Buffett's journey isn't just about numbers, it's about a philosophy honed over decades. He started the Buffett Partnership in 1956 with just $105,000, eventually turning it into billions through Berkshire Hathaway. His approach blends discipline, patience, and a keen eye for value, qualities that every U.S. investor can learn from. Let's unpack the strategies that have made him a household name and explore how you can apply them in today's market. The foundations of Buffett's investment philosophy. Buffett didn't invent his methods from scratch. He built them on the wisdom of 3 key mentors: Benjamin Graham, Philip Fisher, and Charlie Munger. Each shaped his approach in distinct ways, creating a hybrid strategy that's both practical and powerful. Benjamin Graham, the father of value investing. Graham, Buffett's professor at Columbia University, introduced him to value investing, buying stocks at prices below their intrinsic worth. In books like The Intelligent Investor, Graham emphasized the margin of safety, a buffer against losses if things go wrong. For Buffett, this meant seeking bargains, like undervalued cigar butts companies with one last puff of value left. Graham's influence is evident in Buffett's early career, where he focused on cheap stocks with solid fundamentals. Philip Fisher, quality over quantity. While Graham taught Buffett to hunt for deals, Philip Fisher shifted his focus to quality businesses. Fisher's book Common Stocks and Uncommon Profits argued for investing in companies with strong growth potential, excellent management, and competitive advantages. This qualitative lens pushed Buffett to look beyond price tags and assess a company's long-term prospects. Think Coca-Cola or American Express, not just forgotten penny stocks. Charlie Munger, the power of great businesses. Charlie Munger, Buffett's longtime partner at Berkshire, completed the trio. Munger urged Buffett to move away from Graham's bargain hunting and instead buy wonderful businesses at fair prices. His emphasis on durable competitive advantages, or moats, and exceptional management transformed Buffett's strategy. Together, they built Berkshire into a conglomerate that owns stakes in some of America's most iconic companies. This blend of value, quality, and patience forms the backbone of Buffett's success. But how does he put it into practice? That's where his 12 immutable tenets come in. Buffett's 12 immutable tenets, a blueprint for investing success. In the Warren Buffett Way, Hagstrom distills Buffett's approach into 12 guiding principles, grouped into 3 categories: business, management, and financial/market tenets. These aren't abstract theories, they're an actionable checklist for picking winning stocks in the U.S. market. Business tenets, the foundation of a great investment. Step 1. Simple and understandable. Buffett only invests in businesses he can grasp. He avoids complex tech startups or industries outside his circle of competence. For example, he stayed away from dot-com hype in the 1990s but jumped into IBM in 2011 once its value proposition clicked. Step 2. Consistent operating history. He looks for companies with a proven track record, not untested ventures. The Washington Post's decades of profitability caught his eye in 1973, signaling reliability. Step 3. Favorable long-term prospects. Buffett seeks firms with enduring advantages, like Coca-Cola's brand or GEICO's low-cost insurance model that promise growth for years to come. Management tenets, leadership matters. Step 4. Rationality. He values managers who allocate capital wisely, like Coca-Cola's Roberto Goizueta, who boosted shareholder value through smart reinvestment. Step 5. Candor. Buffett admires leaders who admit mistakes openly. GEICO's Jack Byrne exemplified this by tackling the company's 1970s crisis head-on. Step 6. Resistance to institutional imperative. Great managers avoid herd mentality. Think Capital Cities/ABC's Tom Murphy, who ignored trends to focus on core strengths. Financial tenets. Numbers tell the story. Step 6. Return on equity. ROE. Buffett favors companies that generate high returns on shareholders' equity, like the Washington Post's 20% plus ROE in the 1970s. Step 7. High profit margins. Efficiency matters. GEICO's cost-cutting under Byrne turned it into a profit machine. Step 8. $1 premise. Every dollar retained by the company should create at least $1 of market value. Berkshire's investments, like Wells Fargo, consistently meet this test. Market tenets, timing the buy. Step 9. Determine the value. Buffett calculates a company's intrinsic value using discounted cash flow, ensuring he buys below that figure. Step 10. Buy at attractive prices. He waits for market dips, like the 1987 crash, before buying Coca-Cola to get bargains. Step 11. Margin of safety. This Graham-inspired rule ensures a cushion against errors, a key factor in every Buffett pick. These tenets aren't just theory, they've driven Buffett's real-world wins. Let's explore some standout examples. Case studies. Buffett's strategy in action. Buffett's investments read like a who's who of American business. Here's how he applied his tenets to turn opportunities into billions. The Washington Post, 1973, a media bargain. In 1973, amid a bear market, Buffett bought shares in the Washington Post Company for $10.6 million. The company had a simple, understandable business, newspapers, a consistent history of profits, and a strong franchise in the D.C. region. Under Katharine Graham's rational leadership, it boasted high profit margins and ROE. Buffett saw its intrinsic value far exceeded its depressed stock price, a classic margin of safety play. Today, that stake's worth over $1 billion. GEICO, 1976, a turnaround triumph. GEICO, an insurance firm Buffett first admired as a student, hit rock bottom in 1976, with shares plunging from $61 to $2. He saw a consistent history disrupted by temporary mismanagement, not a flawed model. Jack Byrne's candid, rational leadership turned it around, restoring profitability. Buffett invested $45.7 million, betting on its low-cost advantage. By 1996, he bought the whole company for $2.3 billion, a steal that's since multiplied in value. Coca-Cola, 1988 to 1989, the power of brand. After the 1987 market crash, Buffett spent $1 billion on Coca-Cola stock. Its simple business, soft drinks, century-long operating history, and global brand moat screamed long-term potential. CEO Roberto Goizueta's rational capital allocation and high profit margins sealed the deal. Bought at an attractive price, this stake grew to over $13 billion by 2012, proving Buffett's knack for spotting enduring value. IBM, 2011, tech meets value. Surprising many, Buffett invested $10.7 billion in IBM in 2011. Though tech was outside his traditional wheelhouse, IBM's shift to services and software made it understandable. Its favorable prospects in cloud computing, paired with rational stock repurchasing under leaders like Lou Gerstner and Sam Palmisano, justified the move. The price was right, and by 2012, it was valued at $13 billion. H.J. Heinz, 2013, a global bet. In 2013, Buffett partnered with 3G Capital to buy Heinz for $23 billion. Its consistent history, ketchup and condiments, growth in emerging markets, and attractive valuation checked his boxes. 3G's cost-cutting expertise added rationality, turning Heinz into a cash cow. This deal showcased Buffett's adaptability while sticking to his core principles. These cases highlight Buffett's ability to spot undervalued gems, whether newspapers, insurers, or ketchup, and hold them for the long haul. Focus investing, Buffett's secret weapon. Unlike Wall Street's obsession with diversification, Buffett champions focus investing, putting big money into a few high-conviction bets. Here's why it works and how you can use it. The math behind focus investing. Buffett's portfolio often holds just 5 to 10 major stocks, like Coca-Cola and Wells Fargo, which account for most of Berkshire's value. He draws on probability theory, e.g., the Kelly criterion, to size bets based on confidence, not spread risk thinly. This contrasts with index funds, which Buffett praises for novices but avoids himself. Beating the market. Focus investing fueled Buffett's edge over the S&P 500. His super investors, disciples like Bill Ruane and Lou Simpson, also thrived with concentrated portfolios. The Sequoia Fund, for instance, beat the market by sticking to a handful of winners. Why? Fewer holdings force deeper research and conviction, cutting out mediocrity. Tax efficiency. Holding stocks forever minimizes turnover and capital gains taxes, a huge advantage for U.S. investors. Buffett's $1 billion Coca-Cola buy in 1988, still held today, has compounded tax-free, dwarfing short-term traders' returns. How to apply it? Step 1. Pick your winners. Research 5 to 10 U.S. companies you understand deeply. Think Apple, Amazon, or Procter & Gamble. Step 2. Go big. Allocate significant capital to your top picks, not a scattershot 50-stock portfolio. Step 3. Hold tight. Resist selling during dips. Let winners run for years. The psychology of winning. Buffett's mental edge. Investing isn't just math, it's psychology. Buffett's mastery of human behavior sets him apart from the crowd. Behavioral finance pitfalls. Most U.S. investors fall into traps like: Step 1. Overconfidence. Buying hot stocks without research, e.g., 1990s.coms. Step 2. Loss aversion. Selling losers too late, winners too early. Step 3. Myopic loss aversion. Obsessing over daily price swings, missing long-term gains. Buffett avoids these. When Coca-Cola dipped post-1987, he doubled down, trusting its fundamentals over market panic. Emotional discipline. Buffett's contrarian streak shines during crises. In 2008, he invested $5 billion each in Goldman Sachs and General Electric amid financial chaos, moves that paid off handsomely. His mantra: be fearful when others are greedy, and greedy when others are fearful. Tips for U.S. investors. Step 1. Tune out noise. Ignore CNBC's daily chatter. Focus on annual reports. Step 2. Embrace volatility. Use downturns, like the 2020 COVID crash, to buy quality stocks cheap. Step 3. Think long-term. Judge success over decades, not quarters. Patience, the unsung hero of Buffett's success. In a world of instant gratification, Buffett's patience is revolutionary. He waits for the perfect pitch, a lesson from baseball legend Ted Williams. Long-term thinking. Buffett's lumpy 15% a year beats his smooth 12% because he holds through volatility. His Burlington Northern buy in 2009, a $34 billion bet on rail, thrived as the economy recovered. Short-term traders miss such gains. Rationality over reaction. Using Daniel Kahneman's System 1, fast, emotional, and System 2, slow, logical framework, Buffett sticks to deliberate analysis. When others panic sold in 2008, he calmly assessed opportunities. How to cultivate patience. Set a horizon. Aim for 5 to 10 years, not 5 to 10 months. Ignore short-term noise. A stock's daily drop doesn't change its intrinsic value. Wait for deals. Save cash for market dips, as Buffett does with Berkshire's billions. What makes Buffett the greatest? Buffett's not just a numbers guy, he's a unique blend of intellect, character, and structure. Personal traits. Curiosity. He devours annual reports and newspapers daily. Humility. Admits mistakes, like passing on Google, without ego. Integrity. His folksy charm and philanthropy, e.g., the Giving Pledge, endear him to millions. Berkshire's advantage. Berkshire's permanent capital, no client withdrawals, lets Buffett take bold, illiquid bets. Decentralized management frees CEOs like Ajit Jain Insurance to excel without meddling. Learning to think like Buffett. Study businesses. Read U.S. company filings on sec.gov. Adapt. Don't copy. Tailor his tenets to your strengths. Buffett evolved. So can you. Stay true, define your values and stick to them. Market be damned. Applying Buffett's way in 2025 America. The U.S. market today, post-COVID recovery, tech dominance, inflation fears, offers both challenges and opportunities. Here's how Buffett's principles apply. Tech giants, Apple's brand moat and cash flow echo Coca-Cola's appeal. Worth a look? Value plays. Undervalued sectors like energy or retail might hide the next GEICO. Patience pays. With volatility looming, holding cash for a 2025 dip could snag bargains. Visit the WarrenBuffettWay.com for tools like stock valuation calculators to test these ideas on American companies. Conclusion: your path to Buffett-style success. Warren Buffett's way isn't about get-rich-quick schemes. It's about disciplined, rational investing grounded in timeless principles. From his 12 tenets to focus investing, psychological mastery, and patience, his methods offer a roadmap for U.S. investors aiming to build lasting wealth. You won't become Buffett overnight, but by studying his approach, researching quality businesses, and staying the course, you can tilt the odds in your favor. Start small, think big, and invest like the Oracle himself. Your portfolio might just be thankful.